Zacks Rank Buys, stocks with a short-term buy or strong buy recommendation. Now, here are more Zacks Rank Buys. Zacks Rank Buys in the aggressive growth stock category is what we are going to check out now with Bill Wilton. Bill is our aggressive growth stock analyst at Zacks.com, and you got a couple of interesting picks here today. One is Express Scripts Incorporated, ESRX is the ticker symbol, and they are into the management of pharmacy benefits for corporations.
Yeah, they also work with a lot of other organizations, union-sponsored, companies, insurance carriers, other things like that. They also do a variety of patient services. They do some home delivery, and they even do some benefits consulting, which is very big right now as companies are cutting costs in any way they can think of. So they'll go with them as either the lowest cost carrier or use their consulting services to find out what they can do to cut back on those costs while still providing adequate coverage to their employees.
Okay. And as a company, how are they faring and struggling through this economic downturn?
Well, they're doing very well. They're up 33% year over year this quarter.
So it's actually,
yeah, exactly. And it's actually their fourth surprise in as many quarters. And things are going very well for them. They're even projected to continue to do well into the future. They've got 30% growth for this year, which is ending pretty soon. They should be reporting in a month or so.
Okay.
And another 19% tabulated for next year, according to analyst estimates.
So actually, they're benefiting from a recession.
Absolutely. Mainly through things like their consulting services, home delivery. It's kind of like beating a dead horse after a year of a recession. You talk about these healthcare companies being recession-proof, and prescription benefits is one thing that probably one of the last things that people are able to cut back on.
Sure.
So,
and the chart?
Yeah, as you can see,
either.
It's on an upward trend right now. They're facing a bit of resistance that they'll probably test one or two more times, and then you're going to want to look for a breakout there. It's at about $61 is where they're hitting that level. But if they are able to retest that a couple more times, they should be able to break through that.
And in the interest of disclosure, we should also point out here that Zacks Investment Research Incorporated uses Express Scripts Incorporated as the management company for their prescription benefit plan. We just don't want to glaze over that. But that had no impact at all on this company as a choice as an aggressive growth stock because it still had to meet certain parameters, right?
Yeah, they're still projecting excellent rates. Things are looking very good, and we just happen to use them as a great example of cutting costs.
Okay. Hanger Orthopedic Group Incorporated is the next one. HGR, the ticker symbol, kind of speaks for itself. They develop and manufacture orthopedic products.
Correct. They also use prosthetic products as well. So they manufacture them, design them, and they also run facilities that one would go to learn how to use something like an artificial leg.
I see.
They'll train you with it through their patient care centers. So it's a pretty unique industry. They've had excellent quarterly results. They're up 28% year over year in their last announcement, which was their fourth consecutive surprise. As you can see here, they just continue to do well, averaging about 16% per surprise in those. And how do you continue to surprise on that kind of a level? And it's with good financials. You can see here their price to earnings is a discount relative to their industry. They've got almost no debt, which is leading to a very good return on equity.
That has to be a big key these days for companies. If
Absolutely.
you have zero debt or next to it, you can't help but do well.
Exactly. It goes straight to the bottom line. And also when you want to grow in the future, you're in an excellent position to go ahead and obtain more loans or whatever type of financing you're seeking because of that lower debt-to-equity ratio.
So this is kind of an industry that seems to be recession-insulated. I don't know if I'd say recession-proof, but insulated a little bit from economic downturns. There are going to be some people who still need these devices no matter what economy we're in. But when a company is in that kind of an industry that's kind of semi-protected from economic downturns, do they then have to go out of their way on the business level, marketing, merchandising, to kind of ensure future growth, or does it just sort of come naturally?
Well, a lot of it is going to come naturally. You know, you're going to get a set number of patients that, you know, their new prosthetics and orthopedics are going to be covered by insurance. So things like that probably aren't going to go away as much. Where they're going to be limited would be something like acquiring new facilities, opening up new locations where they can go ahead and service their patients better. But that's when that debt-to-equity ratio is going to come in. And when they're ready to start expanding whenever they do decide to do that, they're going to be in good shape for that.
All right. Do you or does anyone in your household own either of these two stocks?
No.
You know, Bill has written about other aggressive growth stocks. He writes about them every week. And all you need to do, if you're locating this video from outside of Zacks.com, to either read the text versions of what he writes or to see other videos in our archive, is go to Zacks.com. And for the text versions, all you have to do is look in the upper right-hand corner where the Zacks ranked buys are kept and go to the aggressive growth category and click on the latest headline next to that. And then you can go to our video homepage if you want to see in the Stock Pick channel an archive of some other aggressive growth stocks that Bill has talked with me about. With Bill Wilton, I'm Terry Ruffalo.